This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
First, let's talk about sterling and some short-term drivers that have turned negative yet again. For more on this, we are joined now by Bloomberg Intelligence Chief G10 FX strategist Audrey Childe-Freeman. Audrey, what's your expectation for sterling right now and why?
Well, we've had quite a good sell-off since mid-July, really, on cable. We moved about 8% lower from 130 to around 122. And, it's quite a big move. And you may feel, okay, what do we do here? Is that too much, too quick? And that's a tempting conclusion. But the drivers that justify that move lower remain in place, and they're mainly UK domestic-driven reason for a more negative outlook for sterling, namely via recession forces that are finally feeding through into the economy, something which hadn't happened in the first half of the year. And the second part to this macro story is obviously related, and that's the Bank of England expectation that are also adjusting to less hawkish expectation. And the next phase will be obviously to a more dovish outlook expectation for Bank of England rates. And that's very much what's been driving sterling. And I feel that in the near term, those drivers remain in place.
So talk to us first just about the economic environment in the UK. Is the UK in a recession? If not, what's the expectation here?
So the UK is not in a recession just yet, technically. But if you look at forward-looking indicators such as the PMIs, both the manufacturing, the services PMI are below 50. So that kind of tells you that we have recessionary forces in place. But in the UK, very much like in many other economies, including the US, where we saw massive tightening in monetary conditions, 515 basis point in monetary tightening in the current cycle, and you kind of expected that to feed through into the economy earlier than it has. And we've seen resilience so far, but I think bit by bit we're seeing that some highly rate-sensitive part of the economy, such as the housing sector and the mortgage sector, are starting to give in. And it can go very quickly. That's the risk. So in terms of numbers, we expect GDP growth just in positive this year at 0.5, but next year could be negative, and we could see 2 consecutive quarterly decline in GDP growth over Q4 and Q1 of next year. So not particularly supportive from a macro perspective.
So it's easy to also look at, say, the cable rate and be like, it's just the dollar. But if I look at the WCRS function, and I go over 3 months, and I put the base in as sterling, it is really down among all G10 currencies with the exception of the yen, which has its own kind of problems. And I'm wondering, at what point do we look at at sterling and say, okay, look, there's so much news priced in that the upside or the potential upside catalyst it could be much more present than we think. What do you think about that?
Yeah, I like the argument. And actually, if you do a WCRS over just the first half of the year, sterling-based currency, you see it was the best currency performer in G10. So we've moved from super bullish to super bearish over a very short period of time. So, so the market is quite on that currency has gone from love to hate, and it could easily go back to love. And longer term, I still think that there's upside value for sterling. It's historically cheap. It's about 20% below its 20-year moving average against the dollar. It's undervalued under most of modeling measures. The positioning is also helpful. So there are reasons to believe that the pound will eventually recover, and I kind of feel that we could see 120 being tested at some point. But because I also expect the dollar to weaken into Q4, I kind of feel that if you're negative on sterling and if you acknowledge the risk I've just highlighted, there are probably better ways to think about it than just cable, and maybe euro sterling upside is an interesting pick, and that's certainly one currency that currency pair that I would favor if you're negative sterling into Q4. I think cable is probably in a range like 119 to 124. If we're right about the dollar likely to kind of have a slightly less robust end to the year than what we've seen in the past 3 months.
It is amazing. Like, remember, Paul, when you used to go to England, it used to be like 2.
Yep.
And it would be like, oh, double the price for everything.
Yep.
That is definitely not the case. All right, Audrey, thanks a lot. Audrey Childe-Freeman joining us, Bloomberg Intelligence Chief, G10 FX strategist.
Let's turn now to the wine market, where Napa Valley's prestigious vineyards are ripe for record years of M&A. This is as the generation of founding vintners look to retire or cash out. For more, we're joined by Bloomberg Intelligence government analyst Andrew Silverman. So, Andrew, this is a thing? You think there's going to be M&A in the wine business? What's driving it?
Yeah, well, so in a sense, I'm cheating a bit because this process sort of started in 2021, 2022, and a bit before that. But now the M&A market has sort of tanked by 30% year over year. But you see vineyards like Schaefer went for $250 million, sold to a Korean conglomerate, and Frank Family went for $315 million, sold to Treasury Wine Estates. So these vineyards are going for pretty hefty amounts, and I should also say that we were just recently in Napa, my wife and I, and everybody was talking about this.
Really?
So I think there's a bit of fear of missing out as well, that these guys are seeing other vineyards going for these large amounts, and they're thinking, could I do this too?
Okay, so there's the FOMO because you want to cash out. What's on the other side? You got cost of capital is going higher. You've had a ton of climate disasters. Input costs are still really high. Labor is still an issue. Like, what of those things are still percolating for the wine guys?
Right. So these vintners that started the industry in the 70s and 80s are getting up there in years, and they're thinking about succession. And succession, as we know, is difficult, especially in family businesses. And they're thinking maybe cash is easier to distribute. And I think their kids and their grandkids are looking at the business and saying, do I want to be a small business owner? Do I want to be a farmer? And of course, like you said, there have been these enormous wildfires, the glass fire, especially from 2017.
Drought. There's drought.
Yeah, exactly. From 2017 to today, 60% of Napa has burnt. So there's that. The climate change. These vineyards depend on microclimates and microclimates. A series of yards makes a big difference. And if the temperature has increased substantially, then maybe they can't grow Cabernet anymore. So that's a big issue. Labor shortages, they're having trouble there. Of course, interest rates have gone up, inflation. So there are lots of different things that they're concerned about, and they're thinking, maybe it's better just not to be in the business at all. And if you scale up, then you cushion the impact of these things a lot better.
So who are the natural buyers here? Is it private equity? Is it strategic buyers? Who's buying this stuff?
Yeah, all of the above. Okay. So you have private equity funds. So the biggest sale of a U.S. vineyard in history just took place a couple of years ago. It was Sycamore Partners purchased Saint Michel, for $1.2 billion. Wow. And you also have, so they're thinking they want to diversify. They also have an enormous amount of dry powder, $1.3 trillion, the most they've ever had, right? And corporations also have piles and piles of cash. They have, $7 trillion. Gina Martin Adams, my boss, has talked about how they're sort of stockpiling cash. So corporations have cash, private equity funds have cash. And luxury companies are also thinking that they might want to follow the LVMH model and become lifestyle brands. So you have companies like Chanel just bought a vineyard, Saint-Supéry. And private equity funds also were thinking, maybe I can package these things and either spin them off into an IPO or sell them to brands like Constellation, which is in the process of premiumizing. I don't know if that's a word. Premiumizing their inventory of wines, selling off their less expensive brands and purchasing the better ones. And a lot of the best brands come from Napa and Sonoma.
Andrew, thanks a lot. Really appreciate Andrew Silverman, Bloomberg Intelligence government analyst.
Coming up with the program, are Vanguard ETF inflows really on the cusp of winning the ETF race for a fourth straight year?
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
While stock and bond markets rise and fall and trends come and go, one thing remains constant. Vanguard ETFs taking in a ton of cash. To tell us how Vanguard has managed a fourth straight flow crown, we're joined now by Bloomberg Intelligence senior ETF analyst Eric Balchunas. So, Eric, talk to us about Vanguard. How much did they take in, and why are they always so good at it?
Yeah, so this year so far, $108 billion, which is a little lower than their typical average at the end of three quarters. That said, in relative terms, it is a very much above average year because that is more than the next four best-selling ETF issuers combined, which includes BlackRock, by the way.
Wow.
This has been an unusually tough year for flows across the board. I think last year spooked a lot of people. And in addition, you've got this gigantic vacuum known as money market mutual funds. Because they now yield 5%, they have taken in almost $1 trillion. And some of that would have been for Vanguard ETFs and other ETFs. And so BlackRock in particular, I think, was hurt by the money market fund trend because they have a lot of treasury ETFs, which have done okay, but nowhere near the money going into money market funds. So it's an unusual year, but as you said in the lead, Vanguard, you could throw anything at them, any kind of environment, and it just seems like they do the same thing. And that's obviously for the reason of being a low-cost provider in an era when that's what people want. And they have branded themselves as this for 45 years. So the branding is powerful. People underrate that. A lot of ETFs are low-cost now. But Vanguard branded itself as this for 30 years before anyone else got even close to being, quote, low cost. So that's a powerful combination for them each and every year.
Can I ask the really stupid question? So what kind of ETFs does Vanguard have in this behemoth that you're talking about?
Yeah, so they do what I would call vanilla. They don't do hot sauce. And there's definitely time for hot sauce, but generally speaking, Vanguard deals in vanilla. So like the 60-40 portfolio, right, which is very popular amongst advisors, right, who have $30 trillion in assets, and baby boomers and all kinds of investors typically are in some form of 60-40. Well, with Vanguard, you could get the 60 in, say, the S&P 500 or a total market fund, each charging you 0.03%, and you can get the 40 in a total bond. You can even throw some international in there for 0.03 as well. So you're looking at an entire 60-40 for 0.03. Again, that's pretty powerful. You're talking about basically thousands of stocks and bonds for basically no cost. That said, what really is driving the flows this year, and 1/3 of the number that I gave you of $108 billion comes from VU. VU is the S&P 500 Vanguard ETF. And what is also in, obviously Vanguard, low fees, but the S&P 500 is also a special brand. A lot of other large cap ETFs don't do anywhere near the business as the S&P 500. So when you combine that rock star branding of that index, which everyone just loves, it's obviously world famous, for a low fee in the brand of Vanguard, it's almost irresistible to the large swath of financial advisors across America and a lot of retail investors.
Can you explain active ETFs to me like I'm a 5-year-old? Because I thought the whole thing about the ETF in general was that they're passive. That's why they can get away with charging a very low fee. What's an active ETF?
This is actually a very good point.
So an active ETF is just like an active mutual fund. It's a person who's picking stocks, And this was in ETFs for the last 12 years. Remember, ETFs just a vehicle. To me, they're like digital music. Like any musician can put their stuff on iTunes or on Spotify. But active was a little late to the party in terms of becoming, putting their strategies in ETFs, because they were like, well, I don't want to show my holdings every day. Also, I'll probably have to charge a little less. So they were like hesitant for many years, and it was just passive, like you said. But because the flows are so strong, it's like a lake where all the fish are biting, and you're fishing in a lake where there's no fish. So they're like, well, if I want to get new flows, I've got to go over to this ETF thing. It's just the preferred vehicle of all these advisors and a lot of retail investors increasingly. So they put their stuff in the ETF. They pick stocks just like they would in a mutual fund. And they've really had success recently because a lot of them have actually lowered the fees as well. And other big brands have entered, like Dimensional, JP Morgan, Capital Group.
So is it cheaper than a mutual fund?
Yeah. So as you know, mutual funds have share classes. And I would say the ETF tends to be priced similar to the institutional class or even the R6 class, which is available only in retirement accounts. So of the classes, ETF would be like getting the cheapest class. So it's not cheaper than that, but it would be the cheapest possible class of the mutual fund, which is smart in my opinion. It might annoy some of the people who invest in A-class mutual funds because, hey, now my manager has offered the same thing for half the fee in an ETF form. And that's why you're going to see a slow migration from many of those share classes over to the ETF class because it's just a better deal. At the same time, though, they're bigger investors who are the institutional and retirement plans. They'll probably stay put because the ETF is priced at the same cost. So that's sort of been the general strategy of active and sort of how to do the least cannibalization possible while at the same time putting their stuff out in the lake where the fish are actually biting.
So when has Vanguard say it had not worked? Like, if there's a downturn or something, does money just shift from one ETF to another ETF? Or has there been a time where, like, this just stuff didn't work because there was something else that happened, exogenous shock or something?
Yeah, so it's a great question. And I recently studied this in a book. And Vanguard investors are ridiculously disciplined. They're like Navy SEALs when it comes to behavioral finance. They never not invest. And I studied this and I thought about this. And so to your point, yeah, there might be some shifts here and there, but largely like that VU I talked about, S&P 500, it was the leading flow getter in 2022 when it was down, I think, the most in 40 years. And I think the reason for this is this. Once an investor goes to Vanguard or a Vanguard-esque fund and they're getting the S&P 500 or the total market for 3 basis points, I think they have what's called the Great Resignation. At that point, they just clock out. They're like, look, got the best deal in the world. There's no need to get tempted by anything else in any different market environment. I know these markets are cyclical, so I'm just clocking out. And I think they just mentally leave watching the market even, and they're just done. And it's like they're off the market. They got married. They're no longer dating. And their money just goes in rain or shine, and I think they have ultimate trust for the company and for the idea of a long-term investment at low fees and compounding, which is where the magic happens. So I think that introducing a low-cost index fund into the market was ultimately a major force for better behavior. Doesn't get credit a lot amongst the academics, but in a recent book I wrote, I gave Bogle quite a degree of credit for just introducing that product because it has really changed behavior for the better. But outside of Vanguard, people do shift around.
All right, well,
and even Vanguard investors make slight tweaks, but not really much.
All right, this ETF market, I'm calling it your market. And Eric, I do not like the structure of your market. It's too concentrated. Do you believe that hinders the long-term health of the ETF market?
You mean concentrated amongst 2 issuers?
Yep.
BlackRock and Vanguard?
Yep.
Yeah. Well, look, this is a big issue because BlackRock and Vanguard collectively own 15% of every company in America. And this has actually got politicians' attention. Bernie Sanders tweeted about it. He's like, what the heck's going on here? Look, this is a real issue. A lot of passive issues are like just, sour grapes, I think. But this one's real. Should Vanguard and BlackRock have that much voting power over our companies in America? And I will say this. They vote down the middle, which upsets the left and the right. So they're always upsetting somebody. But they're pretty much trying to do the right thing.
All right, Eric, as always, we appreciate getting some of your time. Eric Balchunas, he's a Bloomberg Intelligence senior ETF analyst. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
All right, let's turn now to the tech space, where the iPhone 15 U.S. sales could soon stagnate. That's right. It was just released, and we're already talking about stagnating. And this is according to BI's third U.S. Apple iPhone survey. So let's get to the details with Bloomberg Intelligence senior technology analyst Anurag Rana. Anurag, seriously, stagnating? It just came out.
Yeah, but if you look at it, U.S. is a mature market for iPhones or smartphones. So when you look at the iPhone sales, if you have a phone, you're going to just keep it a little bit longer. So U.S. is a mature market, and again, we have talked about it quite a bit. Apple's story is all about emerging markets, and our survey was solely focused on United States and this region only.
So, but talk to us about the loyalty here. I mean, if I'm an Apple user, am I kind of an Apple user for life?
Yeah, this is one of the more highlighting things for us was when we looked at the survey. So we have about 1,600 people who took this survey. Half of them were Android users and half of them were iOS users. So with the Apple users, 93% of them said we're going to keep an Apple forever. But only 80% of them said we're going to use an Android. And that's where the story becomes more interesting, because the Android user by default is somebody that may be having a lower end phone, sub to $300. And as they get a little more richer, it's possible that they're going to choose an Apple ecosystem. And that really is one of the biggest growth drivers for Apple in the long run, not just in the U.S., but in emerging markets. Because if you look at it from a unit shipments point of view, Apple just has 17% of the global smartphone markets by unit shipments. But at this point, they don't even qualify to even bid for some of those units because they are sub $300.
In your survey, do we know why there's less upgrading happening right now?
It's the cost of the phone in most cases, because the phone prices have been going up in the last few years. So when we looked at it, 62% of the participants said that they owned phones released in the past 3 years, down for around 69% last year. So they're keeping it a bit longer on their hand, which essentially means that, you're not going to be able to sell as many units. But the most interesting part for us was that they're really opting for the higher end model. And in this case, the Pro Max model, which is even $100 more than last year, and it's 20% more than the Pro model and 33% more than the base model of Plus. So you will still see iPhone sales go up, but iPhone's unit sales may not go up as much.
So what is the strategy for emerging markets for Apple?
So for the emerging market is you are going to try to entice them with the lower end models first, which is the SE, or for that matter, a refurbished model. There has a lot of services that go with it. And over time, as these people become more affluent, they're going to go from the refurbished phone to an SE phone to a normal phone to a Pro Max. And the Pro Max at $1,200 is a very high-end phone. Because another thing that we are seeing from Apple, they're really releasing most of the best things or the best features only on the highest end models, which will force people to opt for the premium package compared to the base model.
I remember when $1,000 phone seemed bananas.
Exactly. It seems bananas now.
It does, but people are still now. You're like, oh, okay. What is the China risk though? In that we are seeing a big push into sort of nationalism when it comes to buying a smartphone. If there's any more trade issues between the U.S. and China, Apple's a big lever that China can pull.
Yeah, China is the biggest, you could say, wild card for Apple, not just on the revenue side, because they generate about 20% of total sales from China, but also on the supply chain. Almost all the products are made there. I mean, majority of them, 90% of them, are assembled in that region. Now, over time, we think that's going to change. But I would say, the risk to the Apple story is China, and if conditions between the U.S. and China get worse.
All right, so talk to us about the service side of the Apple story. How important is that for investors and for the overall Apple stock story?
It is very important for two aspects. One, it diversifies the revenue stream. Second, it makes the ecosystem far more sticky. You know, if you have all your pictures on iCloud, you're not going to go out and go to an Android phone. But what we saw in this particular survey, that people were pulling back on some of these services, probably because of inflation and spending. The one thing that we worked with our media analyst Geeta on this thing is we saw Apple TV sales, or the percentage of people looking for owning that actually went down dramatically this time. Only 14.5% of iOS users had an Apple TV in 2023 compared to 22% last year. Now, in her research, she has also explained to me that this is very common because people are opting for the lower price Roku and Amazon's Fire TV, and also because of the growing popularity of smart TVs that already have the apps inbuilt on them, that is cannibalizing the market for external connected devices.
So where are the easy levers then for Apple to pull at this point? Or is it all going to be like hard-fought numbers?
It's going to be emerging markets. Because that's
but aside from China, where else?
Oh, India, for example.
Okay.
In India, they have less than 5% market share. I mean, it's just pretty much non-existent in the Indian market. That has a total of 600 million smartphone users. Apple is just pretty much, non-existent from any relevance. Now, over time, as that generation or that population becomes far more affluent, Apple's an absolutely loved brand in India. We expect that to be growing in double digits for many years to come, but it's going to be a slow progression. It's not going to be that it's going to go out and double every 2 years for that matter.
And what do they do with all the cash?
They buy back a lot of shares, and one of the things is that's really there is not a whole lot they can do, frankly. I mean, other than that, maybe raise the dividend a little bit, but the majority of the cash is going to go to buy back shares. They are reducing the share count by about 2 to 3% almost every year at this point. And in a recent analysis, we saw that since 2016, their shares outstanding have been down by 26%. So it's a very big number. So share count reduction remains the most important thing for cash usage. Big number, actually.
Or they can make movies. Isn't the one with Martin Scorsese like one of the most expensive? Wasn't it like $220 million or something?
And Apple's
that they spent? Yeah, right? Am I making this up, Anurag?
I don't remember.
No, okay, either way, they spent a boatload of money on the new Martin Scorsese film to make.
Oh, I didn't know that. I'll check that out. Okay.
All right, Anurag, thanks a lot. Really appreciate it. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.